Hi guys, how are you all doing? Hope you guys have been killing the market. If you're a returning viewer or a subscriber, a member of the Thumbs Capital family, you're welcome back to the channel. To those of you seeing our videos for the very first time, you're also welcome. On this channel, we teach traders how to approach the market using facts and figures only, so as to be able to see the market with the eyes of a true smart money trader. If this is something you will want for yourself, do well to subscribe to the channel and turn on post notification so that you don't miss out on our videos when we drop them. In today's video, I'll be breaking down the EurUsd trade that I took in the third week of August. That's 17th of August to be precise, which I also shared with the community as at when the trade was just about to hit the first take profit. So without further ado, let's jump right into the chart and kick off the analysis. First and foremost, I would like to analyze the same setup using the very popular smart money concept to see how this smart money concept perform with this setup. So on the screen right now, we have the EurUsd 1 hour chart from forex.com, and you can see this day is the 16th of August. So if you zoom out, I don't want to change time frame. I don't want to be going to 4 hours or daily time frame to mark up stuff. So I'll just zoom it out so you can see it clearly. If you zoom out, you can see we have this huge fair value gap right here, which is what the smart money traders use. You can mark up the fair value gap right here that is yet to be filled. Let's label that fair value gap F. Good. So that's the fair value gap right there to be filled, which means the bias is bullish, because the smart money concept traders believe that fair value gap is what draws the market. When you have fair value gap above you, that means it's going to act like a magnet to pull price upward. So with this, we have a bullish bias already on our hands. And if you look at how the market was structured right from the fair value gap, we had a downward movement, then we have this rally, then this base and this rally. So if you are very familiar with the smart money concepts, you know the rally base rally is one of the things they use. So you have the base. When price come back to the base, that's when you expect to start your bullish analysis and find your bullish entry. At this point, which is the 16th of August, we are back into the base right here. So we expect to see bullishness in the market. So the next thing is to analyze to see if we have bullishness. And from what we have right here on the chart, you can see a bullish break of structure right here. OS, that's POS, let's label it. That's bullish break of structure right here. The move that caused the break of structure also left fair value gap, so we can mark up the fair value gaps right there. We have one here and we have another one right after that. There's a lot of fair value gaps, and that means this bullish push is a very good one, leaving us with this order block right here. Let's mark up the order block, which is the last red candle before the bullish push. That's the order block. According to the smart money concept traders, on this order block is where you are supposed to take your buy entry. Now everything is in line. We are supposed to have our buy once price drop to this point. And as you can see, we move forward. When we are moving forward, price created this liquidity right here, which is what they refer to as inducement. The concept works, but the application is where the problem lies. This inducement is a liquidity which we expect price to run into the order block, then the bullish move should begin. Now price kept moving on. You can see another one right here, which is equal lows, and with this equal lows, it's like 100% confirmed that this bullish push is definitely going to happen. But unfortunately, as you can see, as price got into the order block, it broke it and continued moving downwards, making this a failed trade or a loss. That is all about the smart money concepts approach. As you can see, it failed right here. Right now, let's go ahead and analyze the same setup using the concepts that I have taught you right here on this channel. If you are here to see the videos on these concepts, you have to go back to the channel page and watch all our videos right from the beginning. Let's go ahead and delete the markings on the chart. Remove all drawings. So the first thing we are going to do using the Tom's Capital approach is to start our analysis based on time and price. So we are going to start up with the time section. We are going to mark up our timing to know the periods we want to trade. For the sake of this video, I'm only going to start my analysis from the weekly contracts, then I'll go down to the intra-week contracts, to the daily contracts, and then to the sessions. So let's go ahead and do that. So the 16th of August is right here. Go back. So we have the 16th of August right here. If you check the calendar, the 16th of August is in the third week of the month. So we need to analyze and mark up from the second week of the month. And on the second week of the month, the Tuesday close is right on the 9th of August, which is a Tuesday right here. 9th of August, the close of that day is right here. Let's mark that. That marks the beginning of the week. Then we have Wednesday, Thursday, Friday, Monday, Tuesday. This marks the end of the week. The next thing we are going to mark up is the intra-week contract, which is Monday, Tuesday contract. And as you can see, the 15th of August is Monday. So this is Monday open right here. Let's make that dotted line so that we can see the difference. So here we have the weekly contracts and here we have the intra-week contracts. This is the Wednesday to Friday contract and this is the Monday, Tuesday contract. So the next period we want to mark up now is the daily contract, and as you can see, that has been automatically marked by the period separator from trading view. So this is Wednesday, this is Thursday, this is Friday, as you can see it on your screen. So the next one we have to manually mark is the session. That will be the London Open and the New York Open. I have customized my Fibonacci time zone tool in such a way that once I spread it over the day from the open to the close of the day, it automatically marks up the London Open and the New York Open. So that's what we are just going to do right away. So I have selected my Fibonacci time zone tool. Let's put it right here. So open to the close. The green line here is the London Open, whereas the blue line is the New York Open. I know some of you will want to know what the settings are for the Fibonacci time zone tool so that you can copy it. So I'm just going to open up the settings so you can see the numbers. So the number for the London Open, which is the green one, is 0.41666667. Then the New York Open is 0.625. Once you have those settings on, you have to put off the rest of the lines. Put everything off. All you need is just two lines, which is 0.416667 for London Open and 0.625 for New York Open. So let's just mark up the rest of the days. Now that we have all our sessions marked up, the next thing we want to do is to move on to price, because we are done with time right now. Everything we need to mark up as far as time is concerned is already marked up. The next one we want to move on to is price. Now we need to mark up important prices, which are my EBITDA prices. The first one we want to mark up is the major EBITDA price, and we already have a video on this. If you are here to see the video, I'll advise you to watch it right after this one so that you understand what we are doing here. So the first thing we need to do right now is to check the price around the setup, where the setup is forming, to see where we are, so we can mark up the next EBITDA price to the level. So from what I can see right here, I see that the price is 1.0176. That's 176. So the next EBITDA price to that is going to be 150. So let's mark that up. Be around here. Good. So 150 is the EBITDA price around the setup. The next thing I'll do is to mark up the EBITDA price above the level and the one below it. One EBITDA price above the level where the setup is and one EBITDA price below it, so that I'll know where my target, my long-term target is going to be. The next EBITDA price to 1.0150 is 1.0500. So that's to the upside. We are going to mark up that level. Let's just, where's that? Okay, it is right here. The next EBITDA price below 1.0150 is 1.000. I believe all of you know how we get these numbers. It is the EBITDA numbers applied to price. If you don't understand this, that means you haven't seen our video on EBITDA price or EBITDA numbers. You would have to go and watch that video immediately after this one, or you quit this video now, watch that video, then you come back to this to watch it so you understand everything perfectly. So let's mark up 1.000. That's going to be our target. Now that we have our major EBITDA prices, the next thing we want to do is to mark up our liquidity zones. The setup we are looking to trade is for the 17th of August. That means we are yet to see what price has done right here. So let me just shift that to the other side so we don't see it now. So let's analyze as if we are right now in the market before the price or the candlesticks are printed. We want to look at the liquidity zones. Now from the Monday Tuesday contract, we have this low right here with this ABCD swing to the upside, which makes this level a liquidity zone, which I've marked. Then if you look at the high also, we don't have any liquidity zone there, but because it is a contract high, it is important, so let's just mark that up. Also, I like to put the dollar sign right below my liquidity zones so that I understand what the zone represents. I'll put another one right here. Imagine what we have right now. We have a liquidity zone right here. We have another liquidity zone right here. And from my institutional analysis, I know the institutions are very bearish. They are selling the market. So that means I also want to sell this same market. And if you look at it, we have our liquidity zone, first liquidity zone here, which means we are going to use this as our first target. This is where price is going to be drawn to. Now we also see that we are on a major EBITDA price, which means this setup is going to be a swing one, which is going to go far to the next EBITDA price, which is 1.000. Now what we are left with is our entry. Now looking at what price has done here, we have a minor liquidity right here, which we expect price to run so that we can enter our sell trade. I'll mark that up and add the dollar sign so I know it is another liquidity that we are going to use to enter our trade. Now that we have determined where we are going to be taking our trade from, which is on the run of this liquidity, that means our entry is going to be above this level right here, which is 1.01948. Now we are going to mark up our minor EBITDA price above that level. That's where the minor EBITDA prices come to play, and you already know our minor EBITDA prices are based on 100 pip range, so we look at the 100 pip range above the level. So the price we are looking at is 1.0194. That means the next EBITDA price from here is going to be 1.0200. So we mark that up. Let's do that. I'm going to change the thickness of the line and the color. Let's make that gold. That's good. So we have the golden line represent our minor EBITDA price. So we need to adjust this to make it 1.0200. That is our next EBITDA price there. And the next minor EBITDA price after 1.0200 is going to be 1.021500. That's 15 pips. Now we have our minor EBITDA price where we want to take our trade, which is the 1.0200 and 1.02150. All we need to do is just to wait for price to come into that zone, and then we look for reversal pattern to confirm our sell. And our first take profit is going to be at the liquidity, which is the Monday Tuesday contract low, and our final target is going to be 1.0000. All we need to do is to wait for price to hit our minor EBITDA price, which happens to be our entry zone. As you can see, this price came there very close. Now we see price hit our zone right here. So that's where I'm going to be looking for my reversal pattern. So let's just put up a sell arrow right there. Now we need to go to a lower time frame to find our entry pattern, a reversal pattern, to confirm that yes, this is really a sell zone and the price is going to reverse from there. So let's change the time frame and go lower to 5 minutes or 15 minutes. Now we are on the 15 minutes time frame, which is a lower time frame where we can analyze our confirmation reversal pattern. We are definitely going to use one of the reversal patterns that I taught in my ultimate reversal pattern video. If you are here to see that video also, you need to watch it so that you can know the reversal patterns to look out for. On this setup, the liquidity zone we want to use to enter our trade initially is this one. Now price hit our zone right here, we need to look for reversal pattern, and if you look at price action from where this liquidity is to where price hit our minor EBITDA price, you can clearly see the reversal pattern, which is one of the 5 that I taught you, and that is the consecutive liquidity zone reversal pattern. If you look closely, you can also see the liquidity pool reversal pattern, but the liquidity run on that failed to hit our minor EBITDA price, so we are not going to be taking that. Let's mark up the reversal pattern so we can all see it clearly. Now from the low, we have this swing to the upside, and from there we have the first ABCD swing to the downside right here. That is our first liquidity, which we've already marked from the 1 hour time frame. Price took out that liquidity right here, after which a new ABCD swing was formed. We can mark that as A. That's A, B, C, and D. Let me zoom out a little bit more so you all can see it clearly. The first liquidity zone was taken out right here, after which a new ABCD swing was created, leaving this place also as a new liquidity zone. Let's mark up that level with the dollar sign so you can see that it's a liquidity zone. From our liquidity video or the ultimate reversal pattern video, we already know that the second liquidity run is where we look for our entry. So let's mark up the second liquidity zone, which is right here, and it was taken out right here. So at this point is where we are supposed to be looking for our sell entry, but due to the speed, you can see on the 15 minutes time frame, it's only a week that we add right here before price drops. So that price action is so fast. And I also explained to you in the reversal pattern video that if you miss it because of the speed of the price action, you have nothing to worry about. I already explained this in the reversal pattern video. I told you if you miss the entry at the final liquidity run, you have nothing to worry about, because price is definitely going to return to retest the first liquidity zone to give you your final entry. So that means our entry is going to be at the retest of this low. As you can see, price failed to test it, but I also told you in that video that you need to leave at least 2 pips or 1.5 pips of clearance so that you don't miss the opportunity by few pips. This is a clear example of that. This means our entry price is going to be 2 pips below the first liquidity zone, which is 1.0194. that means our entry price is going to be 1.0192. Let's just mark that up. 1.0192 is our entry price. Let's place the risk reward tool on that, and our stop loss is going to be few pips from the high, which is right here. So few pips, let's just maybe 1, 2, or 3 pips above the high. And our first take profit is going to be at the run of the low of Monday, Tuesday trading. And our second position is going to be same entry, same stop loss, but different target. We have the same stop loss, but the target in this case is going to be the next major EBITDA price, which is 1.0000. Mind you, are not going to leave your position to be running on this without any management. Definitely you have to move your stop loss to break even after hitting the first take profit, and then you continue moving your stop loss using the minor EBITDA prices or using structure or whatever you like. That makes our first trade a 1 to 5 risk reward trade, and the second position a 1 to 13 risk reward trade. The screenshot I posted was right at the first take profit, which is the liquidity run of the Monday Tuesday low, and the second position I left to run till the final take profit, which is the next major EBITDA price. And if you look at the screenshot clearly, you will see that I entered new position around this zone. That is because price retraced, and whenever I see this kind of retracement, it's always a very nice opportunity for me to enter more positions so that I can maximize my profit potential. So what I just did in that case was I added a counter trend line to this retracement into the New York session. So I waited for the break of the trend line. Immediately I add this break. On this little retracement that we have right here is where I started entering my new additional position, which are scaled in positions, and the stop loss I placed right here. What the entry looked like was this. I think I had my entry around here, and I placed my stop loss few pips above this high. So, and I had my first take profit. I opened more positions. I think I had 2 or 3 positions. My first take profit was here. The second position was similar. It's the same entry, same stop loss, but different take profit level. So I think I had my entry right there. The stops were here, and the take profits right here at the same level with this first position. That is it, and that was how I was able to catch the trade. This one happened to be a 1 to 1.8 risk reward trade, and the second one was 1 to 7. And that is it about the setup. That's everything I saw to take the trade from the beginning to the end, and that's going to be the end of this video. If you are new to the channel or you're yet to subscribe, please do it right now. Subscribe to the channel, turn on your post notifications so that you don't miss any of our videos. I still have a whole lot of things to teach you. This is not everything about trading. We still have so many things that you need to know, because this is not going to be the only type of setups you'll be taking. So I'll advise you to just stick around on Tom's Capital. I'll be dishing out more content, more lessons, more trade breakdowns. I'll see you guys on the next video. Keep catching peeps, keep killing the market. Have a good day and happy trading.